Let's move on. Moving on to chapter 12. Some more details about life insurance. Insurance. Everybody got their notes, right? All right, here we go. Okay, so who can own a life insurance policy? The owner of the policy, not necessarily the beneficiary of the policy, but the owner of the policy. It can be the person who's insured. You can also own the policy. You can own a policy and name yourself as beneficiary, or take out a policy and give it to the beneficiary. A trust can own an insurance policy. What you need to have to own an insurance policy, a life insurance policy, is insurable interest. Okay? All right, so under the ownership clause of the policy, okay, the owner possesses all the rights while the insured is alive. Again, the owner and the insured are not necessarily the same people. Okay? And rights of an owner include naming who the beneficiary is going to be. Okay? The owner has the right, not necessarily the insured, but the owner has the right to surrender the policy for its cash value. Okay? The owner has the rights to borrow the cash value from the policy. The owner has the right to receive dividends paid on the policy. Okay? The owner has the right to structure how the death benefit will be paid out. Okay? And the owner has the right to change who owns the policy. The owner can assign the policy. Assign ownership. Okay? Okay. So this idea, the entire contract clause states that the policy and the application constitutes the entire contract. And so you're wondering, what does that mean? Why do we bother to say that? Okay? Well, it is for the protection of the insured. Okay? This idea that the contract and the application is everything. There's nothing outside of this contract. Therefore, the insurer cannot void the policy, okay, unless a statement on the contract or the application, okay, is a material misrepresentation, okay, by the insured. So if the customer says something that's untrue, and it's something that is very important to the underwriting process, absent that, the insurer cannot then come back in after the fact later on and say, we're not paying the claim. Okay? So this prevents the insurer from making amendments to the policy without the policyholder's knowledge and consent. So it protects the owner of the policy and it protects the beneficiary. It keeps the insurance company from playing games. Oh, by the way, there's an amendment that we made. You know, someone dies, a death benefit, a claim is made, and the insurance company says to the beneficiary, oh, we came up with this amendment 10 years ago. We didn't show it to anybody, but it says that if the policyholder dies from a heart attack, we're not paying. No, you can't do that. That's what this is about. Okay, everybody up to date there? Caught up? All right. All right, the incontestable clause. All right. What this does is it gives the insurance company 2 years to review the application. They have 2 years to find out if there's anything wrong with the application. If they don't find something wrong after 2 years, they cannot void the contract. Okay? So it gives them 2 years, the insurance company 2 years to find a misrepresentation. Okay? So the burden is on the insurance company to find the fraud. And they have 2 years. So if a customer says something wrong, they got 2 years to find it. Okay? All right, so there are limits to this protection. Okay? So if a beneficiary, so if the owner is not the insured, but the owner is the beneficiary, okay, then if they can prove that there was an intent by the owner, who was also the beneficiary, to commit murder, then the insurer can contest the claim after 2 years. So that's subject to an investigation. All right? Someone else takes the medical exam. Listen, folks, we're human beings. Human beings will do anything. It's pretty crazy. Excuse me. My dad used to say some people will do anything for money, and you, as a pure-hearted person, you don't want to believe that, but you've all seen enough movies. You know it's true. Okay. All right. And if it can be proved that an insurable interest does not exist at the time the policy was taken out, then all bets are off. The insurance company doesn't have to pay up. So these are exceptions to the incontestable clause. Okay, and again, this is all about moral hazard, dealing with moral hazard, trying to remove moral hazard from the equation. Okay? All right, the suicide clause. This was interesting to me. I always thought that if a person took out an insurance policy on themselves, that if at any point they committed suicide, that the insurance company would not pay. I always thought that was the case. And you know, we've seen that in all kinds of movies, you know. It's not true. Okay? 2 years. It's 2 to 3 years. It's state by state. Okay? So if your intent is to kill yourself and make sure that your family gets the insurance, you're going to have to plan ahead. That's the lesson here. All right? And, you know, I don't want to make light of it. It's interesting to me. Does anyone here know anyone who's committed suicide? I do. I do. You know, one of my friends did. I think I mentioned it. Not a good friend, but he was a good friend of my father's. Killed himself back in the summer. He was a money manager. And another one of my friends, who was younger than me, killed himself, probably about 4 years ago now. And, you know, you just wonder, how a person gets into a situation where they feel like that's the best option for them. And sometimes it's circumstantial, where it's really a bad set of circumstances, and sometimes, and a lot of times, it's also biological, it's physiological, where you have chemical imbalances, and if a person has chemical imbalances and is not taking medication, for either because they decided not to take their medication or because they haven't been diagnosed, then that's how you get into that position. It's a disease. Depression is not it's not a mood. Depression is not a mood. It is a disease like cancer, and it has to be treated as such, medically and with psychotherapy. And so as you get older, when you're in your 20s, you think, how could someone do that? How could it ever get that bad? But particularly when there's depression involved, it can get really bad. And I know a man who was in his late 70s, and he was diagnosed with stomach cancer, and he killed himself because he didn't want to go through it. He told his family that he did not want to do chemo and the surgery and linger for a couple of years, and so he killed himself. So I'm not saying it's right. I'm just saying that was the choice. That was the choice that he made. All right. Okay. Let's see. So if the death benefit is not paid, the premiums are refunded. So you're talking about 24 months of premiums. Okay. All right. So if there's any question about whether it was suicide, then the insurance company has to prove that it was suicide. And again, when you have a big company, Congress is taking the side of the individual against the big company. All right, grace period. All right, what happens if your policy, your due date comes and goes, and you, for whatever reason, fail to pay? Okay, you get 31 days. It's called a grace period after the premium is due to pay. Okay. Someone might forget. Someone might be on vacation. Someone might be tied up with, things that are very distracting. Maybe someone in the family died and the policy due date happened. There's any number of circumstances that could distract someone. Okay? All right, reinstatement. Okay, so the policy has lapsed, and you find it and you're horrified. Like, oh my goodness, what do I do? Well, you can reinstate it. Okay, so what do you have to do to restart a policy? Okay, well, you're going to have to go back in and have a medical exam. Insurability means a medical exam. Then you're going to have to pay all premiums that were missed. It's expensive. Okay? And you're going to have to pay interest on those premiums that were missed. Because remember, the insurance company invests those premiums. Okay? If there are any policy loans that are outstanding, they have to be repaid. Okay? You cannot reinstate a policy if it was surrendered for cash value. Can't do it. All right, and there's a limit to how far you can go before it's reinstate it. Okay? You can't play games with your policy and say, okay, I'm not going to pay for 3 years or 5 years and then get it reinstated at the rate that existed when I initially had the insurance policy start. You know, I was 35 and now I'm 45 and I'm going to take some time off and then go back in and start it over, reinstate it, and expect to pay the same premium as when you were 35. You can't play games with the insurance companies. They're not going to let you do it. That's what this is all about. Okay? All right. When you do reinstate, even though you have all these costs, you don't have to pay commissions over again. And that's pretty big for a couple of years. Okay? All right, these periods don't renew, so you don't have to wait 2 years. You want to kill yourself, you can do it right away. All right. The disadvantage of reinstating, a lot of cash to do it. It's high cost. And there may be new products out there that have better terms for you and better premiums. Okay? So you don't just automatically reinstate. You got to check it, look around, and see. And by the way, if your policy lapsed for 3 years, it's a life insurance policy, you know, you're basically paying the insurance company back, but a claim wasn't made. You're still alive if you were the insured. See what I'm saying? So you just have to look at it and say, okay, am I better off reinstating the policy, or am I better off starting over again with a brand new policy? Okay, and it really depends on what has happened to premiums during that time period, and how much older have you gotten. Okay, if you cross the magic threshold of 45, you might be better off paying your back premiums than paying new premiums going forward. You'll have to do an analysis. Okay. Misstatement of age or sex. So we know that age and gender have a big impact on premium. Men cost more than women, okay? And older people cost more than younger people. And this is much more important than this. This is the single most important factor, and this is second. Okay? And it all has to do with the odds of your death. All right. All right, so does it mean that the death benefit is not paid? No, that's not what it means. By the way, a misstatement is not fraud. A misstatement is an accident. Okay? It's not intentional. Okay? So the insurance company goes back and computes what the premiums would have been if the correct age and sex had been stated to begin with. Okay? And then the death benefit is adjusted. That's what happens. They're going to pay a death benefit. They're not going to hold out on you because of that, but they are going to. So all things, you know, if you were older, if you said you were 35 but you were 37, they look at how much insurance, how much death benefit could have been purchased for the amount of premium that you actually paid, and it might have been $50,000 less. So instead of $1 million, you only got $950,000, and so they're going to adjust down the death benefit. That's what they do. They don't deny the claim. They just adjust it. Okay? So if they catch the mistake before a claim is filed, then they'll either adjust the death benefit down or they'll adjust the premium up. So they'll visit with you and say, okay, you got two options. We're going to lower your death benefit to $950 and you keep on paying the same premium. Or we're going to have to increase your premium to make up for it. Okay? You choose. All right, see? There's always a process, you know. The insurance business has been around for a long time. They've seen every imaginable case, and they made adjustments for them. Whoops. All right. Good to go? Everybody good to go? Okay. Okay. So, the beneficiary of a policy is the party named in the policy to receive the proceeds. Okay, who gets the death benefit? The beneficiary cannot surrender the policy. The beneficiary cannot change the beneficiary. The beneficiary cannot cancel the policy. The beneficiary does not state how the policy settlement will be made. They just receive the proceeds. All right, so we have the primary beneficiary. This is the first party entitled to receive the proceeds. Okay, who's going to get the death benefit? The primary beneficiary. Okay, you can have more than one primary beneficiary. That happens a lot. Okay, the amounts to be paid to each must be specified if you have more than one. Okay, so bank accounts have beneficiaries, investment accounts have beneficiaries, insurance policies have beneficiaries. And you have to make sure that there are beneficiaries listed, that there is accurate contact information about the beneficiaries, and the amounts that each beneficiary will get are listed. Okay? And the amounts are either listed in dollars or percentages. Okay? And as the owner, you can decide how much you're going to give to each party. It doesn't have to be thirds if there are 3 people. You make that decision. All right. Then there's the contingent beneficiary. They are entitled to the proceeds if the primary beneficiary dies before the insured dies. Okay? You can have a contingent, and when at that point, if the primary dies, before the insured dies, the owner can come in and change the beneficiaries. And the owner can do that at any point. They can change the beneficiaries, but they cannot do so under duress. In other words, you can't point a gun at a person's head and say, make me the beneficiary of your policy.